Well, last week was a bit of a bloodbath when it comes to tech stocks, and there's every chance that you're probably now in a stock position that's underwater and you're looking to potentially sell covered calls below your stock purchase price. Today, I want to take you through a few do's and don'ts. I'll show you some of my positions that are underwater that I'm looking to sell below purchase price if need be. But firstly, not financial advice. It's simply what I'm doing and have done based on my individual goals and risk profile. Do not blindly copy random strangers on the internet. Do your own research, make your own decisions, and get good at managing your own money. So, firstly, selling covered calls below our purchase price. Let's take a look at some of the mistakes, what to do instead. And I've got an exact trade that I'm looking at this week for a position that's underwater. I'll actually show you another one from last week as well. Overall assumption though, you still believe the stock has potential and will return to your purchase price. If that's not your belief, then we should probably look at getting that stock out of our portfolio. But the assumption for what I'm going through now is that the stock will come back. It's strong, it's solid, it's good. We're just down. So mistake number one is selling your covered call too far into the future. Oftentimes when our stock position is underwater, we make this next trade out of fear and, oh my God, I just need to get something and it's never going to return and it's going to take forever. So we sell too far into the future. I'm talking 30, 60, 90 plus days. We need to keep these contracts short dated, 1 week, 2 week at the most, so that we can maintain control. When we're selling too far into the future, that's where we get trapped with a strike price has been breached and we can't roll it because there's just we haven't collected the theta on it. There's just not a good roll because it's so far dated into the future. So we keep our contracts to 1, 2 weeks at the absolute most. I would even say if you're selling below cost base, try your hardest not to go out 2 weeks. A week is usually plenty. Mistake number 2, selling too far below your purchase price at the wrong times. So we want to make sure that when we're selling below our purchase price, we're doing it at the right times. And that's all based on what the chart tells us. We'll go into the charts and have a look at the right and wrong times to be selling below our purchase price. But you can do it. Just make sure we're doing it at the right time. And number 3, waiting for a green day. I hear that advice often. Just sit on your hands and just wait. But if that green day doesn't come for a couple of days, you were probably better off selling that covered call when you had the chance rather than waiting for an up day. Because an up day is only good if it's higher than the days before. If you have another couple of down days before you get your green day, then selling that contract puts you in a worse position. And mistake number 4, you wait too long to roll. You now sit there and rather than crossing your fingers and hoping and wishing that the stock price goes up, it gets up and then we're like, no, stop, don't go up. Whereas all we need to do is roll that contract a bit sooner and we can generally manage to keep our trade safe. So what do we need to do first? There's 2 numbers that we need to know. Our entry price, which is just our stock purchase price, not including any premiums, not including if we sold a put to get the shares, not including that premium, because if we lose that premium, it's like that trade didn't exist or like we lost that trade. So we just simply stock purchase price. And then our safe price, which is our stock purchase price less any premium received. So that number there gives us the number whereby if we sold it at that price, we haven't lost anything from the entire campaign on that stock through other covered calls and I guess essentially like wheeling that, the put to get the shares and so on and so forth. It's like that just didn't exist. We broke even. And then we want to go in and identify the current chart activity. Now, let me give you these 2 prices on a stock that I've got at the moment. Credo, I purchased at $130. My safe price is $122. So I purchased probably going on 2 weeks now, and so far I've received $8.21 in premium, which brings me down to, let's call it $122. Let's go in the chart and let's also look at some different contracts on what I could do to sell some covered calls to still collect my weekly premium, but still keep this overall trade safe. Okay, so here we are inside the Credo chart. After this one as well, I actually want to take you over to silver and show you how I managed three or four different covered call transactions on silver last week, all below my cost basis, because the charts are different, and I think that's key to point out. So here we are. This is my purchase price line, 130, and last Friday I sold a 132 covered call. By last Friday, we were still at the, are we going up? Are we going down? We looked like we'd, pretty well bottomed here on the RSI. Could have gone either way. Obviously did not. So I'd sold my last week's call above purchase price. Great, that part's easy, right? The next thing I did was, as soon as that covered call was pretty much in 100% profit, I closed it. So that closed on the Tuesday for $10. There was $10 left. So I had $512 worth of premium in that covered call. I collected $500 odd, closed it. Now, why didn't I just wait? Well, if I wanted to sell another call on one of these days, I just wanted to have the opportunity to do so. So closed on the Tuesday, potentially could have reopened on the Wednesday. Now, why didn't I? Was because of this big, giant red candle. Now, this candle says to me, you know what? We've had a significant downtrend. I'm not sure if we're going much further. If I thought we were still, and we'd been going down for 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. That was 11 red days straight, which is a lot, right? If we were on to maybe this second day, that would be a different story. That would tell me, you know what, maybe we've got some further downward potential. Let's sell a covered call just above my safe price if I can, because the chances are we've got a little bit more downward momentum and I can collect that premium safely, okay? Whereas once we've had this kind of movement, we're then getting to the point of anything I sell here is likely to be gobbled up with an upward movement, which it would have been. So at this stage, we're trading at 111.40 and my cost basis or my purchase price is 130. I could very well sell a covered call for this coming week and have it at that 130, right? The reason why I didn't is because the chart's telling me right now, you know what, there's probably a few more up days left. So I will absolutely make sure that I'm collecting some sort of premium this week, but I just want to wait to see how high we can get. Because if we can get even back up to this call it 121 mark, then obviously I'm going to get more for my call if I sell it even at the same 130, right? The other thing to take into consideration is if this upward trend doesn't happen, all right? What if we have a red day again on Monday? Well, then I'll go in with my covered call. I'll look at selling at the 122, or give or take 122, which is my safe price, okay? Let's come to option strat and just play around with a few different ways that this might play out. Okay, so here we are inside of option strat. We're looking at a covered call on Credo. Ignore the chart itself and ignore my long shares at 111. Obviously, that's not my purchase price. All I want to do is highlight the difference between the strike prices and the dates. And I find option strat is a much easier way to do it than going in and out of contracts on your trading platform. So first thing, all we want to do is look at a week in advance. Now, I could sell still at my purchase price of $130 for a $75 credit. I could have done that on Friday. But remember, I believe there's more upside. So I don't want to cap this premium, right? Even if I sold at my 122, my safe price, I could receive $190 worth of credit. But because I'm expecting a bit more of an upwards move this week, I would rather not roll. So I would rather wait for this movement. And if we get that movement up, then potentially I'm selling for my 130 call at this kind of pricing at a 190 premium. And that would be a much better trade to take. What I also like to look at is implied volatility. So right now we can see 13th of Feb, implied volatility 88%. And as we're going through the dates, Feb 20, 86, Feb 27, 92, March 6, 106, March 13, 107. So as we're going through, the implied volatility is increasing. These dates here between the 13th and the 20th, neither here nor there, okay? The reason why we want increasing volatility rather than decreasing is because when we're going for our roll, we don't want to be buying back expensive contracts, selling into cheaper contracts. And when we're selling into higher implied volatility, it means the contract we're buying back is, all things considered equal, cheaper than the contract that we're selling into. So that's something to take into consideration as well. Okay. So the play as far as Credo goes this week is, let's just wait and see what kind of upward momentum we get. And then by the time it comes for me to place the trade, I will have more of an indication as to, okay, we've got that next upward move. If it starts to look like we're sort of settling, at least I'll be closer to my 130 to be able to get that next premium level. Now I want to show you silver, because silver is different. Now I've got a bunch of words on here and I want to show you exactly what I've done so far on silver. So last Friday, I sold a covered call at the same expiry I had for the week before, which was 103, all the way up here. And I sold that on this day here. Now, you might look at this and go, why on earth did you sell it up there? Because in this stage, it was still very, what is happening, right? We didn't really know where silver was going to go. I just wanted some premium. So for me, that was a good trade. Obviously, coming down the following day, on the Monday, we were not going to go back up anytime soon. So what did I do on Monday? I closed that trade because I'd extracted most of its value. I had $10 left on that one, so I closed that one, pocketed my, 111 rather than 121. And then I opened for a Wednesday expiry, because I'm only using short expiries, an $83 call at $39 premium. So that's this line here, 83. And I opened that on the Monday for a Wednesday expiry. Okay. On the Tuesday, we had this little update. Are we near my $83 yet? No. But I don't care, because I want to get as far away from the current trading price as possible. So I rolled. To the Friday expiry. I rolled to $86, which was up here, and received another $29 credit. Okay. So even though the day that I rolled, we'd closed still a significant distance away from my strike price, I never, ever, ever want that to be breached. So I rolled it to the next expiry, enough for a credit, but also enough that I felt like it was a safe enough distance and I could just continue to do this. Something like silver is great. And now these new tri-weekly expiries on, Amazon, Apple, Nvidia, it's going to be great if you need to do this, because it just gives you little teeny tiny bits of movement in short period of time. Ultimately, that all expired worthless on the Friday. Actually, I closed it. Where was Friday? Here. Closed all of that. I think it was for $1. There was nothing left. Closed that. And then I sold the $80 Wednesday, which is, where's 80? Down here. For an $87 credit. And this week, I plan on doing the exact same thing. As the stock price comes up, I'm just going to continue to roll into the next expiry just to gain those few extra dollars, because I would rather get some form of credit along the way, but not in any way, shape, or form find myself at risk of that strike being breached, because then rolling is hard. And then that's where you end up having to go significantly into the future and your trade is tied up for ages. So if I get even just a little move up on Monday, even if on Monday we're at like, call it 75, I'm going to roll that. And then I'm going to continue to roll it. And as long as I'm receiving little bits of credit along the way, that's okay to me. Why didn't I wait on this one? So why did I wait on Credo and not this one? Purely because right now silver is very much a what's happening kind of a trade. And also because silver has those tri-weekly expirations, it gives me more flexibility yet again. And it's easier to roll. So that's my play for silver this week. That's my play on how I'm selling covered calls below my cost base. I definitely don't go out too far in advance. I would rather smaller premiums and more frequent trades until I'm back up over my safe price. Once I'm at my safe price, then we can start to get a bit more aggressive with the amount of premium that we're collecting. But until then, I'm happy just to continue to collect small amounts whilst making sure my strike is never breached. That's the ultimate goal when you're in these trades, is make sure that strike is never breached. Roll before you need to. Never wait. Don't sit here and think maybe it won't touch that. Don't sit on it. That's my biggest advice. If you're thinking, do I roll this? Just roll it. Just roll it. Go out for the week and only ever roll out to the week like in front of you, because otherwise, as the stock price is climbing, you're also then missing the ability to roll that to the future week. So that's my play with these trades that are a bit underwater at the moment. And obviously the idea is that they get back up to their original purchase price and we can continue to not just collect the covered call premium, but ultimately collect the capital gains as well. So I'd love to know what stocks you're trading at the moment that are a little underwater. If there's even if there's anything that you've done with covered calls where you're like, you know what, this one worked out really well, or you've got some tips or tricks, I would love for you to share them with me as well. And if you found this helpful, then absolutely subscribe to the channel. Let me know in the comments. And hopefully for all of us, this week gives us a bit of a reprieve and some nice green days along the way.